Learn price behavior, learn market advantage. Hello everyone, this is Bella talking. Welcome to my video on information price behavior. We've covered trend correction patterns in the previous lectures. Today, we're going to start studying trading bands. 2. What are the characteristics of the trading band? Let's take a look at several trading range cases. The first one is that the market entered the trading range after a two-stage downward strong trend movement in the 2-hour chart of gold. The second one is that gold made an upward channel for 2 hours and the price entered the horizontal range movement. The third is the 4-hour chart of US crude oil, a two-stage decline, a strong upward correction followed by a trading band. In this case, we can see that the market usually moves rapidly before entering a trading band. The sharp movement may be a strong trend movement or it may be a strong pullback from the trend. It doesn't matter. The important thing is that the market always has the sharp movement first. Why does the market usually have trend movement before it enters the interval movement? Let's recall what we talked about before why the market has trend movement. Let's take the example of a downtrend in this case, where the major players in the market all agree that prices should go lower, and so the leading bears are adding to their positions and the leading bulls, in this market state, are sitting on the sidelines, wait until the price falls to where they expect it to be before they start buying and reparticipating in the market when the major players in the market share the same view, in this case, that the price is going to go lower, less resistance to price movement in this case. Less resistance to the downside because the bulls are sitting on the sidelines for a while, so there is a trend movement. But what happens when the downside movement reaches the point where the bulls are expected to enter? The previous downtrend movement was so smooth because the major bulls in the market were temporarily out of the market and the price had reached the point where they expected to buy. This judgment of the expected target could be an important level of support, and it could correspond to an important level of support in the big cycle, and you could see a selling surge in the market where the downside movement has been in full swing and the bears have run out of momentum, or they could be using some indicator algorithm that we don't know about, and they decide that this is where they can enter the long side. We don't need to find that exact reason. The important thing is that there is a buying force in the market. And we need to read that out of the K chart to make a little bit of a digression here. Why we don't need to get to the bottom of it, just read what the K chart tells us and take gold as an example. There are countless large players around the world trading gold, such as central banks around the world, including our central bank in China, the world's largest financial institutions such as UBS, or the world's 4 major investment banks, Merrill Lynch, Morgan, Goldman Sachs, Citi, or large commercial enterprises Mitsubishi in Japan, for example, plus various funds and investment banks, and even the richest people in the world who buy gold, and so on and so on. And so many of these large players are playing the game in the market, and the result of their game is the direction that the market chooses. So can we possibly figure out what tools each of these institutions are using to analyze the market? What is really being analyzed with fundamental analysis? What are the data being analyzed with technical analysis? What are the analytical tools being used? Who is trading software? What are the rules of their EA design? It's impossible to figure out what every major player is thinking. It's not realistic, but the traces of their game and the outcome of their game are shown on the graph K. So I keep saying that we just have to analyze what the graph K gives us, and that raises a new question. Right? Why do so many people think that the market is being cut by the market? So many large institutions are participating in the market, and we small retail investors have enough money to fill their teeth if you lose money and think that the market is harvesting you. That is a sign of 2 things. One is that you are hiding your head in the sand and you are not willing to accept that you are not able to lose money in the market. The second is that you may participate in the variety of volume is very small. No empty main game is completely the dealer control plate. If you like to participate in this kind of variety, then you cannot blame who lost money. If we go back to the chart, how do we see the bulls participating in the market? So if you look at the details here, the market first saw a selling surge and the bears ran out of momentum. How do you see a selling surge? First of all, The price has gone down very quickly here, it has corrected, and then it's gone down very quickly, and then it's gone down very quickly, and that's what we've been talking about, is that the bear momentum may run out, and here we have two very strong negative lines, and it just continues to go down without a lot of complicated correction, and that's the market, and it's going down very fast. It's prone to this phenomenon where the bear runs out of momentum, and after a selling surge the market makes a simple pullback, a simple correction, and then a false breakout to the downside. So here, he makes a false breakout in time to the previous band point, which is the previous trend. What is a false breakout after the breakthrough? There is no short to follow up the strength of the selling surge, coupled with the emergence of a downward false breakout. Many major bears will begin to gradually take profits, and major bulls they subsidies to such a weak short strength signal will naturally catch live time to start to build up entry. The current state of the market, can we say that the bulls strong? Can say that the bulls have an advantage? Of course not, if the bulls strong price should have broken up. Does that mean the bears are strong, or not? Because we see that the bears have not been able to push the price down in this sideways, near 100k lines, and both the bulls and the bears are continuing to participate in the range-bound movement of the market price, and the market is starting to get a little bit uncertain, and we're saying there's a 50/50 chance of the range breaking out. However, strictly speaking, the probability of breaking in the direction of the trend is a little bit larger, but the probability advantage is small. We should focus on the observation of the trend movement of the long and short main forces of the same view. One side continues to enter, one side temporarily exits. The wait-and-see interval movement, the long and short main forces of the diverging side wants to push the price to the trend pole. The countertrend believes that the current price is worth participating in the continuous entry. Here, we can also understand from another angle that the trading range is the area that both bulls and bears believe has trading value, while the trend movement is that the market is looking for this value area. In the value consensus area, the main forces of both bulls and bears continue to participate. Will choose to temporarily exit the market wait-and-see range. The market will be broken into the trend movement to find a new price area, and both bulls and bears will actively participate in the market again to form a new trading range. There are no more than two movement states of price: trend movement and non-trend movement. That is, trend and range. The market breaks through a value area to find new value, then breaks through and stops. And it goes on and on and on and on. If the price breaks through a value zone and doesn't go too far before it stops forming a new value zone and then breaks back into the old value zone, that's what the market is. It goes from a small area to a large trading band. The bulls and bears don't agree on the direction of the market. Both sides are still actively participating in the large value area. The up channel or the down channel is a slanted trading band. The long and short main forces are actively participating in the market in the channel. One side has a slight advantage, and many novice traders have a misconception that the bulls have a big advantage in the up channel. In the downtrend channel the shorts have a big advantage, and it's a very simple logical argument to prove that this is not true. If we take this downtrend channel for example, if the shorts have a big advantage, the price should just go down, but it can't go down every time the price moves to the channel line. We've all seen bulls actively participating in the market to push prices back up the range, so it's best to treat this channel as a clean trading range. How can we determine the formation of a trading band on the chart? The first example is the 6-hour chart of NZD/USD. He first had a strong bull push to push the bull trend to the extreme. Of course, this last push is partly a channel. I'm not going to draw it in detail here because it would look messy, and after the bull trend was pushed to its maximum, the market had a deep pullback, and in fact this pullback we found was a sharp pullback and then a pullback to the beginning of the channel. The bull trend continued after the deep pullback, but the continuation did not make a clear break in the trend direction, but a break in the trend direction. He failed to adjust again, this time gaining support at the previous band points. What happens here is that when the price is supported again at the previous continuous point, we think that the market has formed a potential trading band, and then what happens after that is the movement of this band. As a side note, if this correction is not supported in the previous band year and it breaks down strongly, then it's a potential reversal pattern that we'll talk about in the reverse film. Let's look at the second case, again the 6-hour chart of the NZD/USD, where the market has a sharp decline followed by a deep correction, and after a deep correction the break in the trend direction is the break in the downtrend, and it fails, and it doesn't even test the downtrend pull. After the low failed to break through the low, the price again made a deep adjustment. This adjustment was verified at the previous band points, which is the downtrend. We called the verification resistance. If there is no support here in the previous band and it just breaks out of the previous band, then it is no longer a potential trading band but a potential reversal pattern. We just used two cases which are fairly standard and relatively simple. We will encounter various variations in the actual market, but in general, the formation of the band is dependent on these steps. It first has a trend pullback, preferably a deep amplitude pullback, and then cannot break through successfully after the trend pullback. It means that the trend energy is weakened and the next pullback is supported at the former band point. If it fails to get support at this time and directly breaks through the former band point, it is a potential reversal pattern. When these first steps occur, we think of the market as having entered a potential trading range. Notice the word potential, not necessarily entering a trading range, but potentially. If the next step is to verify the formation of the range, that is 2 band highs and 2 band lows, it is fully verified, then it is a proven educational range. At the time of the formation of these steps here we thought it was a potential trading band, because the trend energy was down and there was no contrarian breakout of the market. There was a pause in this price area, and one of the things that we've seen with these trading bands. And what you find is that it's not one of those bands like the top band and the bottom band that's perfectly parallel, that kind of standard trading band, that kind of trading band that's the textbook and trading band that's perfectly equal with the high and low bands. That's very hard to come across in actual trading, really rare. Most intervals look like this, and they're irregular, and you have to make sure you understand that. So what's characteristic of a trading band is that price movements have inertia, and it's very important to keep that in mind for your chart reading and trading. Whether it's trend movements or range movements, the market tends to stay in its current state of motion, so in a definite trend most potential reversals fail to evolve into trend continuation patterns. So I don't really recommend that novices go into reverse mode. For example, a lot of people like to do a double top, a head shoulder top and a bottom, and you'll find a lot of double tops. When you build an economy it's a failure, and it becomes a continuation of a trend because the market has an inertia, and it tends to maintain the current state of motion, and the trend tends to continue, and in well-defined intervals most of the breaks in the interval will fail, and it will become a false break. Because an interval is also a state of motion in the market, and the market tends to maintain its current state of motion, and that's a very important point. So if we look at this 1-hour gold case, where the market starts to become a potential trading range, how do we know that? The strength of the previous bull push led to an extreme deep pullback, followed by a long extension that made a false break of the previous band highs, and another deep move that gained support at the previous band lows. Let's say the market may have become a potential trading band, and then it confirms what we think about this interval, and what we find is that once this interval is formed it runs for a very long time, and this interval also lasts by estimation more than 100k lines. And there are a lot of fake breakthroughs, like here, and there's a bad example of why I don't recommend you do this double top bottom inversion, or head shoulder top bottom inversion. Like here is actually a very standard head shoulder case. If you connect it like this you'll find 2 shoulders, a head and a neckline. This downward break is a false break, it's a head and shoulders failure. You get caught up in it, and if you think of it as a range you're not so easily played by the market. You're not so easily caught up in it. I've been saying for a long time that I really recommend that when you trade a head shoulder top or a double top bottom reversal pattern that you trend back into the trend direction. It's a very good trade because it follows the trend. If we look at the previous cases of ranges that lasted for a very long time and were prone to false breaks up and down, that's the characteristic of trading ranges that lasts a very long time and the market tends to stay in motion and it's prone to false breaks. Like this down channel, which is also one of the things that happens during the trading session, where you have false breaks, false breaks, false breaks, false breaks, false breaks, false breaks, and it ran for a very long time, which is characteristic of trading bands. So what we've seen in the previous cases is basically how do you participate in a range, and in a nutshell there are two kinds of trading in a range. One is trading in a range, which is what we call high above low, or I like to do a false break in a range, which is to do the reverse when the break fails and the price comes back into the range. These trades are based on the assumption that the range is going to run, and that means you're going to trade within the range. The other kind of trade is to make the break of the interval, which means that we no longer think that the interval runs, and we think that it has turned from the interval to the trend. We will explain the trading method of the interval in detail later in the course. Okay, thank you for watching. Please consider like, comment and subscribe. Also don't forget to share to your friends and follow up for an upcoming video. Bye.